Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Stocks plunge as Trump's tariffs kick in, including a 104% levy on China. Beijing weakens its currency. Chinese officials say they have the policy tools to fight. Bond market turmoil, 10 and 30-year Treasury yields soar, threatening the asset's status as a haven. Plus, former Treasury Secretary Larry Summers tells us tariffs could push the US into a recession, potentially putting 2 million Americans out of work. Good morning. Trump's tariff wrecking ball careens through the markets. Downside being flagged by European futures. You're seeing the pressure over in Asia. Less so on mainland China, on expectations that the national team is stepping in. But we'll get to the Asian markets shortly. Futures in Europe then pointing down by more than 4% after the gains of around 2% yesterday. So more than offsetting the downside that we saw, the upside that we saw yesterday for European stocks. FTSE 100 futures pointing low by more than 3%. The drop on S&P E-minis in terms of expectations around the US equity market moves 2.4%. Nasdaq 100 looking to drop 428 points. Those tariffs are now in force, including 104% on the imports from China. Let's flip the board and have a look cross-asset then, because arguably the asset class of the moment to focus in on is the rout in the Treasury markets, particularly at the long end, the 10s and the 30s. The 30-year yield now up more than 60 basis points since last week, 60 basis points in terms of the yield, higher on the 30-year. The 10-year, a move higher in terms of yields of close to 14 basis points, 443 right now. The question you have to ask yourself is, what breaks in this environment? The euro soaring on softer dollar. The safe haven status of the Treasuries then crumbling in the current environment. 110 on euro dollar. Brent at $60 a barrel, just holding above that $60 level. But pressure again on oil prices, close to 4%, the drop there. Gold getting a bid in terms of that safe haven move. The yellow metal up 0.8% so far in the session. Let's check in on the Asian market then. You saw the gains yesterday in the Nikkei on some relief, short-lived now, that Japan was front of the list in terms of trade negotiations. The reality is, of course, that takes a long time, and we are nowhere near close to signing a deal, it seems. The MSCI Asia Pacific then, the broad benchmark across the region, currently down 2.6%. The pain trade is around the Nikkei then, more than outdoing the gains that came through yesterday. A drop of almost 5%, 4.7% right now across Japanese stocks. The CSI 300 over on mainland China, down just 0.3%. But again, different factors coming into play when it comes to mainland China and the national team and expectations of fiscal support from Beijing. The Japanese yen is gaining. That is bid. The Japanese currency is up. That is one of the factors why the Nikkei is down. Currently up 0.9% then, the Japanese currency. And you're seeing those gains in terms of the Swissy as well. Let's cross over right now to Brendan Murray, who leads Bloomberg's trade and supply chain coverage for the latest on the implementation of these tariffs. Brendan Murray, just talk us through what has been implemented about an hour ago from the Trump administration.
Well, the main thing is the 104% tariff on China. This was much higher than people expected. President Trump regularly talked about putting a tariff on China of about 60%, and so here we are at 104. The implication of this is pretty stark. As we can see, a company that has $100,000 worth of product on the ocean right now coming to the U.S. That is now going to cost them more than $200,000. So they're going to ask themselves, how am I going to come up with that money? So a lot of people think that this will cause, obviously, trade to relocate, to shift around. But in the short term, it could just kind of seize up. Companies could just stop ordering things until they see where the dust settles with whether these tariffs are going to be permanent or they're going to be a negotiating tool that leads to some sort of deal in the short term.
Brendan, talk us through where things stand in terms of potential retaliation, whether it's from China or the European Union, and the timeframes that we're looking at.
Yeah, it's interesting. So far we haven't seen any retaliation from the Chinese based on the new tariffs. They are guiding their currency weaker, but that to be expected. But so far, we didn't see any snap announcement of retaliation from China. The European Union, we expect later today, is going to announce some retaliatory measures of $22 billion on $22 billion worth of American products. This is based on the steel and aluminum tariffs that Trump put in place a few weeks ago. So we could start to see as many countries come to Washington to try to negotiate their way out of these tariffs. We could see the pressure coming toward Washington in the form of retaliation. So we'll have to see how that plays out.
Okay, Bloomberg's Brendan Murray, thank you. As these tariffs are implemented, of course, with the focus on that 104% on Chinese imports into the US. For the reaction, more reaction from China, where that tariff is now in effect. Let's go straight to our Bloomberg China correspondent, Minmin Lo, standing by. Minmin, how is the Chinese government reacting to these new levies? How seriously are they taking it? What have they got up their sleeve in terms of support for the domestic economy and hitting back against the US?
Yeah, it's a very curious situation because I was just monitoring the Bloomberg terminal over the last hour or so, and we haven't actually seen any news lines from any Chinese ministry so far in terms of fresh rhetoric or countermeasures. And this is quite an interesting situation because we know that China has said it will fight till the end. China has said they will retaliate, but so far, while they have retaliated against the 34% reciprocal tariffs, they haven't retaliated against the additional 50% levy that Trump added on later. So what does China have up its sleeve, and when will it really fire those bullets is still an open question. But we have Premier Li Qiang saying that China has ample policy tool space to fight those tariffs. He said China's macroeconomic policy so far has already taken into account all the uncertainties, and it looks like all the attention now is turning inwards on how to support the economy. We did see back-to-back headlines from Xinhua yesterday of all of these state-owned companies coming out to announce share purchases to put a floor on the capital markets. We saw Chinese markets flipping between gains and losses today, and suddenly the losses we're seeing on the CSI 300 is much lesser compared to other regional benchmarks. That's because of the national team pouring in a record close to $12 billion to buy up the ETFs yesterday, and they're continuing to support the capital markets today.
OK, Bloomberg's Minmin Lo in Hong Kong as we're looking, yes, at mainland Chinese stocks essentially flat so far in the session, so diverging, as Minmin was saying, from the plain trades that we're seeing across the rest of Asia. Let's get the broader look at how markets are digesting then this latest wave of tariffs and bring in Bloomberg M-Line strategist Mary Nicola in Singapore. Let's start with the equity market reaction then, Mary, and futures pointing to a brutal session for Europe.
Yeah, it has been a brutal session as well in Asia because of the fact that investors are still hoping for some sort of last-minute salvation, some last-minute negotiating deal, but nothing has really come through. So now tariffs have been officially implemented. We've also had a rampant sell-off in U.S. yields, and it looks like the fact that we have policy uncertainty, a lack of policy credibility in the U.S. has caused this surge in selling of U.S. assets, but it's also filtering into Asia because at the end of the day, Asia is going to struggle with slower growth, not only from the U.S. but from China. And of course, with the implication of 104% tariffs on China, that obviously has global ramifications in Asia, specifically for a lot of the small open economies. So sentiment is going to remain under pressure for quite some time.
And you hit the nail on the head in terms of the question marks about the credibility of this US government right now. And that seems to be one question, at least for those involved in the Treasury market. Meanwhile, over in Japan, the sell-off is there as well in terms of the 40-year. The yield there over in Japan rising 32 basis points. That's the highest since its debut in 2007. That's a redhead across the terminal in the last few minutes. Meanwhile, Japan's Ministry of Finance, the BOJ and the FSA will hold a meeting at 4 p.m. Japan time as well to see if they can coordinate, it seems, action, or at least discuss what is going on in these markets. Mary, what is happening in terms of the Japanese bond market? The safe haven status had been there, but at the long end, that selling pressure is also being seen in Japan.
Yeah, that's been everywhere, frankly. And and of course, it's whatever's happening in the U.S. is going to trickle down into the rest of the world. And that's what we've seen in the bond market sell-off, not only in Japan, but in Australia earlier this morning. So the effect has been widespread. I think what we're seeing, though, especially at least in the currency markets, and that's worth looking of where investors are looking to hide or seeking refuge. And that's really come through in terms of seeing how the yen is performing, how the Swiss franc is performing, and even on the euro. And that's where it looks like the attention is being directed there to look for some refuge, because at the end of the day, at this point in time, it doesn't look like bonds are holding up. And of course, recall that earlier this year, bonds were actually doing quite well. So the initial trigger of the sell-off could have been to cover some of the losses from equity markets. And now there has been this violent move, as well as it continues to precipitate and concerns about just, let's say, a broader stagflationary environment.
Okay, excellent breakdown from Mary Nicola of our MLive team. What's happening more broadly across these markets? The lens, of course, on the FX space as well, with euro dollar, to your point, Mary, currently gaining 0.8% on the single currency, actually outpacing the gains for the Japanese yen, which is up 0.7. The sell-off then in Treasuries, as Mary was saying, gathering pace, with long-end yields rising most amid selling pressure as investors scramble to raise cash. Bloomberg's Valerie Teitel has a focus and an eagle eye on these Treasury markets. Val, give us the size and scope of what is happening.
This is a historic week for the Treasury market. Those long-end yields have risen some 50 basis points just from Monday alone, and that 30-year yield breached the 5% level just an hour ago. This is really maybe the beginning signs of financial stress in the market. Flip on, let's take a look at the 30-year yield over 3 days, because breaching 5%, man, that is a 50 basis point rise in yields in a matter of days. This is showing us that there is perhaps a lack of balance sheet out there in order to absorb these treasuries. Because, Tom, if you are a corporate, you're under financial duress and you need cash on your balance sheet, you're selling your high quality assets, you're selling your treasuries. But the problem is you need someone to buy them. And what the market is telling us now is there is not a lot of balance sheet out there. There's not a lot of dealer capacity to take down this risk. And we are seeing it, especially in swap spreads. Take a look at the 30-year swap spread. It had one of the biggest moves ever in the session yesterday, showing us that, hey, there is a lack of balance sheet out there to absorb these treasuries as investors, companies around the globe look like they are scrambling to raise cash.
Yeah, and to your point, the auction yesterday out of the US was badly received, and you have a 10-year auction today and a 30-year on Thursday as well. So be scrutinising those given the rout that we're seeing right now, particularly at the long end in the US Treasury market. What does this portend in terms of potential cracks elsewhere? Bloomberg's Valerie Teitel, thank you. Coming up, you can, of course, keep up to date on all the latest news and market reaction from the tariff rollout on your terminal by typing TLiveGo onto the Bloomberg terminal for the most up-to-date reaction and analysis from our team. Here's what else we'll be thinking about then today. It is all really about tariffs, but beyond and above that, if you want to focus on what is happening in the travel space, then Delta earnings coming out later. That is a gauge, of course, on the US consumer on those US recession risks. So we'll break that for you. 6 p.m. Meanwhile, UK time, we're going to have that 10-year note auction after the basically badly received auction of yesterday. So the 10-year is today. 7 p.m. UK time, we get the Fed minutes as well. We'll break those for you, of course. Expectations that the Fed at some point may have to come in from the sidelines, though, of course, the inflation risks are a challenge for the Federal Reserve. You can get a roundup of the stories you need to know to get your day going in today's edition of Day Rate. Terminal subscribers can go to DAYB Go. The tariffs are in force. That is, of course, the driving story of today, of the week, potentially of the year. Coming up, 20% tariffs go into effect on imports from the European Union. We're live in Brussels with the latest reaction. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Let's get the European reaction to President Trump's new tariffs with a 20% levy now in force against the EU. Bloomberg's Oliver Crook joins us from Brussels. Ollie, how is the EU reacting to this new reality?
Yeah, Tom, I think we should just take a second here to mark the moment of what is happening here and what has basically been underway for the last hour and 15 minutes here, which is basically largest trading barriers in a generation and maybe several generations for all the goods shipped from the EU going into the United States now facing a tariff of 20%. Tom, right now, beginning right now, all of that sort of pricing, that 20% is working its way through the producers, working its way through the consumers, working its way through all of these businesses to try to figure out where all of this pricing is going to finally rest. And for the Europeans, their determination now is to figure out how to respond to this. What we expect to get from the Europeans now and what we expect to get today is the retaliatory measures, not to the tariffs that just went into effect, but the retaliatory tariffs to the steel and aluminum tariffs that came into effect a couple of weeks ago. What we will get today from the EU, we are hoping to get, is the list of goods that will be targeted by the Europeans. We should say, Tom, this will be a fairly modest list. This will only affect about $20 billion worth of goods in a relationship that's worth $1 trillion. And that is deliberate, Tom, because the Europeans are still holding out hope that they can negotiate a deal with Donald Trump. But then things get really more interesting, Tom, is next week when we get that broader list. And this is going to be the list of retaliatory tariffs to the 20% that we got overnight. And Tom, this is the sort of mother lode from the European Union. This is where they will begin to think about targeting U.S. tech companies, U.S. services, and really expanding that out of just a sort of narrow lane of goods. And that is going to be the conversation that goes on next week. If they cannot negotiate a solution, we should say, Tom, and we should continue to reiterate that the Europeans, there is no one in Europe that does not want to negotiate a solution. However, the Trump administration does not seem terribly inclined at this stage to even talk to the Europeans about this.
Yeah, we had a reminder of that yesterday, didn't we, with President Trump giving the EU another characteristic tongue lashing. So how likely is a deal going forward, given where the president stands around his animus towards the EU?
Yeah, Tom, I think it's very, very hard to say. I think that right now I can't say there's a huge amount of optimism. As we were reporting earlier in the week, the trade ministers here in Europe are preparing Plan A. Plan A was negotiation, and Plan B is retaliation. In terms of the probabilities, they wouldn't really give me one, but I think that increasingly Plan B looks more and more certain. That being said, Giorgia Meloni, Prime Minister of Italy, will be heading to Washington, D.C. next week. She'll be meeting with Donald Trump. She will be trying to do the diplomatic effort. She is there to represent the EU in a certain sense, to try to get some concessions, to try to advance the conversation on tariffs. That being said, if the conversations with Benjamin Netanyahu, a very strong ally of the United States, are anything to go by, that may be a tougher conversation than anticipated. That being said, Tom, I think we should also say that Pedro Sanchez, the Prime Minister of Spain, right now is in Vietnam. He touches down in Beijing on Friday. Pedro Sanchez has talked for a very long time about maybe a closer relationship with China, and maybe in the context of what's going on with the United States, trying to rethink the policy towards China and really trying to establish China as a more stable partner. That is what the Chinese are trying to say, saying that they're a more reliable partner now than the United States. That being said, all of the trade ministers I spoke to earlier in the week are not at this stage really willing or having any inclination to have a sort of major rethink of the relationship with China. But Tom, as this goes on to royal markets and the United States' position becomes clearer and clearer, it is not completely out of the question for the Europeans to start thinking about this.
Yeah, the unthinkable has certainly at points become the thinkable, hasn't it? We'll see if the EU looks to dust off that potential trade deal that they worked on around 2019 with China, that they eventually, of course, dropped. Oliver Crook in Brussels, and looking ahead to that meeting, of course, between the Spanish leader and his Chinese counterparts, which takes on added gravity in the current environment. Now, some of the stories making the news. Boeing logged its best delivery performance in more than a year, handing over 130 aircraft in the first quarter. It comes as the US company works to improve its factory processes and narrow the gap with Airbus. Boeing's rival is scheduled to unveil its monthly orders and deliveries later today. Santander is said to be exploring options, including a potential sale of its majority stake in its Polish unit. Spain's biggest bank is working with an advisor to review its 62% stake in the unit, which is worth about $8 billion. The review of the Polish stake comes as the lender focuses on expansion in the Americas. Let's check in on European and US futures right now as investors again wake up to the reality that these tariffs are now imposed. We had the 10% tariffs imposed across the board, of course, over the weekend, and now you have the additional tariffs on around 60 nations, including, of course, 104% on China and Chinese imports into the US. China, of course, has threatened to retaliate and respond. European futures plummeting more than 4% after the gains that we saw yesterday, wiping those out as things stand. US futures as well. Another volatile session yesterday, currently pointing lower on the S&P E-minis by a little over 2%. Nasdaq 100 futures dropping 377 points, dropping 2%, more than 2% so far. You're not too far away from a drop below, about a 30% drop below the 200-day moving average for the Nasdaq 100. Tech has been particularly badly hit, of course, as a result of these Trump tariffs. Coming up, we're going to speak with the UK's trade minister during President Trump's first term on how Britain and the world should respond to these tariffs. That conversation with Greg Hands later on in the programme. Stay with us. This is Bloomberg. Former Treasury Secretary Larry Summers is warning the US is likely heading for a recession as a result of President Trump's tariffs. In an interview with Bloomberg's David Westin, Summers says 2 million Americans could be out of work.
I think this is fundamentally a improvisational effort. You could tell that when you knew that there was a policy based on tariff reciprocity that didn't use any data on the tariffs of other countries in figuring out how to reciprocate. You could tell that from the blatant contradictions between what presidential advisor Navarro was saying and presidential advisor Treasury Secretary Scott Bessent was saying. You could tell that from the degree of division between close outside advisor Elon Musk and many members of the president's economic team. This is a policy, it's a hugely consequential policy, but by all appearances, it's being improvised on a daily basis, and that's creating huge uncertainty. But it's only uncertain. There's only uncertainty if things go in both directions. And today happened to be a day when things moved in a positive direction. I hope that the moves to back off these policies can continue, but we'll have to see. I suspect we're going to have volatile markets for some time to come, and no one can know, but my judgment is that I'd be surprised if the bottom is yet in with respect to this phase and markets.
How bad could it get?
Oh, I think the likelihood, I think it's more likely than not that we're going to have a recession. And in the context of a recession, we'll see an extra 2 million people be unemployed. We'll see losses in household income that are $5,000 a family or more. We're very likely in the context of a recession to see markets reach levels significantly below their current levels. So I think we could be looking for fairly serious economic problems.
Coming up, how to position in this market volatility, the rout that we're seeing in the equity and bond markets. We'll bring in the views of Patrick Armstrong, CIO at Plurimi Wealth. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Stocks plunge as Trump's tariffs kick in, including a 104% levy on China. Beijing weakens its currency. Chinese officials say they have the policy tools to fight. No hideout for havens as the bond market sell-off continues. 10 and 30-year Treasury yields soar, with Japan's 40-year yield hitting its highest since its 2007 debut. Plus, former Treasury Secretary Larry Summers tells us tariffs could push the US into a recession, potentially putting 2 million Americans out of work. Today is another day for the history books then. The tariffs have now been imposed. Tariffs now being imposed at the highest levels in over a century on imports flowing into the US. 104% on China, 47% on Vietnam, 20% on the European Union. The list goes on. Equity markets sell off. Bond markets sell off. Ray Dalio coming out and warning of a once-in-a-lifetime breakdown in monetary, political and geopolitical order. Futures in Europe pointing to losses of more than 4% after the gains of 2.7% yesterday. FTSE 100 futures looking to drop 268 points. US futures after another day of volatility. Volatility, by the way, in the Treasury markets at a multi-year high. Volatility in equity markets again, down 2.3% on S&P E-minis. Nasdaq 100 futures pointing to a drop of 400 points. Let's flip the board and have a look cross-asset. Treasuries, a safe haven? Not so no longer, it seems. There has been a bit of a pairing in terms of the sell-off that we've seen. At one point in the session today, we saw yields up 21 basis points on the 30-year. The 10-year now seeing yields up 11 basis points. So pairing some of the heavier losses, but continuing to see a sell-off across the US Treasury curve as that safe haven status for US debt is called into question. 439 right now on the benchmark US 10-year. The dollar is under pressure. Euro up 0.7%, 110 on single currency, $60 a barrel on Brent. We'll see to what extent that $60 level holds. Currently down 4% on concerns about recession risks. And gold getting a bid, up more than 1%. That is and remains something of a safe haven, holding above that $3,000 level on the yellow metal. Let's briefly check in on the Asian markets then as well, where you've seen increased selling pressure on the Nikkei. That index dropping 4.3% after the gains of yesterday. Across the benchmark in Asia, 2.4% is a drop. Mainland China is actually in positive territory. The national team riding to the rescue, up 0.2 on the CSI 300. And the Japanese yen is bid as well as a safe haven currency as we look to a meeting 8 a.m. UK time between officials in Tokyo, up 0.7 on the yen. With higher tariffs now in effect then, the long end of the US Treasury market is facing that renewed pressure as investors scramble to raise cash. Overnight, the 30-year yield on the Treasury, the 30-year Treasury yield jumped another 20 basis points, as I mentioned, in what Bank of America's Mark Cabana described as a fire sale. The sharp move is likely to raise fears that the world's most liquid bond market could be at risk of a pandemic-era style collapse. What breaks in this environment? Bloomberg's Valerie Teitel is here and has been watching this closely. Val.
Tom, some terrifying moves, I put it frankly, in the Treasury market in the last 3 days. We've now seen yields skyrocket, and this is not because we are repricing the Fed or worried about inflation. This is frankly what looks like a scramble for cash on balance sheets. We have to take a look at what's going on in swap spreads. I'll go through this. It's a bit in the weeds, but it's a measure of balance sheet availability, and that's important because if you are a corporate under financial strain and you need cash on your balance sheet, you're selling your liquid assets, that being your treasuries, but you need someone to buy them in order to get that cash on your balance sheet. And what the market is telling us today is that there are not many buyers of treasuries right now. The balance sheet out there is not what it needs to be in order to give this liquidity to the market. So that's what the treasury market is telling us. Perhaps the good news, Tom, though, is on the more funding markets. We're talking about overnight collateral, overnight repo, cross-currency basis. We're not seeing funding stress yet there is hints of it, but it is not the extent that we're seeing in the Treasury market.
I'm really glad that you made the linkage between the Treasury market and the credit market. And we saw the auction yesterday when it comes to the Treasury market, badly received by the markets. We have another auction today, 10-year, and then the 30-year tomorrow. What are you watching for?
Oh, this is pivotal because we have to remember, October 2008, March 2020, the catalyst for market dysfunction was a weak auction. And March 2020, it was a weak 30-year auction that led the Federal Reserve essentially come in and do liquidity operations, essentially do QE to calm the market down. So these are pivotal, catalysts for further market dysfunction. If we go into that auction today and it shows us that there isn't balance sheet to take down that auction, because it's 38 billion of 10-year notes, there needs to be balance sheet to take that down. If it's not there, you end up with dealers already suffering from too much balance sheet and can't offer that liquidity to end users. So I'd have my keen eye on these Treasury auctions. We not only have the 10-year, but we also have the 30-year later this week.
Yeah, and this is before China makes any moves around ditching any of its treasuries, which of course would be a nuclear option, but one that some have suggested Beijing could at some point consider. Valerie Teitel, thank you very much indeed. From our markets team, of course, monitoring what is happening, particularly in the Treasury markets and the rout that continues today with yields up across the curve. Let's bring in right now Patrick Armstrong, CIO, Chief Investment Officer at Plurimi Wealth. Patrick, good morning. Thank you for taking the time. How bad does this get, do you think?
When Europe responds to the tariffs, which I wouldn't be surprised if we get an outline what they're thinking today. That's obviously going to create the risk of another U.S. retaliation to Europe's response. So we're not in the end game yet, and I'm actually not surprised to see Treasury yields moving higher, because this week people have been talking about increased recession risks. 100%, that's the case, but it's a stagflation risk. This global trade war that we've got now is stagflationary, unequivocally. It's going to lead to higher prices, lower growth, stagnating economies, and it's toxic for equities, obviously, and for bonds. So it is a pretty tough investment backdrop for traditional investors.
And Patrick, given that stagflationary environment that you're now seeing, what does that mean for central banks? Can we assume that the Fed at some point will be pulled in from the sidelines?
The Fed will probably have to act. Powell's outlined what his thinking is. He's going to view this as transitory, which my base case still is. We are going to see significant rollback on these in probably this month, but there is maximum chaos as Trump does try to create an environment of maximum leverage that he can exert some sort of economic gains out of these policies. So it's a very hard environment when you're buying things. It's a great environment if you do have the ability to short things. The Japanese 10-year yield is still way too low. You've got 3% inflation there and yields less than 2%. So it's an environment where you have the flexibility. There are some assets maybe you want to own, but if you can short that, that's a great way to play a stagflationary backdrop.
And I want to unpack some of those calls from you in a moment, Patrick. But on that time frame around potentially rolling back some of these tariff measures within a month, how do you start? Talk me through how you start to position for that, or do you?
I think if you look a few years out, if you're buying equities today, it's probably not a terrible entry point if you're buying good companies that have a sound business model, that have pricing power, because we are going into an environment with a higher cost structure. It's not going to be a complete rollback of tariffs, but this is an opening position from Trump, and it's still going to be a pretty extreme position we get to if we get to a middle ground. So businesses that have pricing power can pass on their higher costs to the consumers. You want to avoid companies like autos. We've got shorts in 12% of my short book is in auto companies right now because of the way they build their cars. They cross the border so many times on parts assembly and different parts of the process. Those kind of companies are at extreme risk, and they're a very high profile tariff item that everyone sees cars every day on the road. So tariffs, even though it's not incredibly important for the economy, it's incredibly visible. So those kind of stocks I do think will remain at risk.
What other portfolio changes have you and the team been making, Patrick?
So we started to dip our toes into equities on Monday, and we've been telling clients also to be building equities, but not with all your dry powder, to be building it during this month, because we did get a glimpse on what happens, and it will happen quickly. As soon as there are discussions and a rollback of tariffs, equity markets will bounce. When there were rumors that tariffs were going to be pushed out for 30 or 90 days, the market rallied extremely quickly. And we're at a point, probably not of peak pessimism yet, but I wouldn't be surprised if we get to peak pessimism this afternoon as Europe maybe lays out their response. And building positions slowly, gradually over time, I do think will be a winning strategy right now.
What do you do is tech included in that call, Patrick? I know you've had a constructive view on some of the tech names, Nvidia, most recently. That stock is down, 30% year to date. What are you doing with tech? Are you holding, are you adding, or are you selling?
So I've been selling put options because the implied vol on these stocks is so high. And I may miss out on that sharp rally, but I'm getting a 10% premium to sell a 10% out of the money put on a stock that I like at current levels right now with a month to go. So it's implied volatility. Picking up stocks at a discount to where they're already trading at is a strategy that forces that buy discipline. So I think that's not only you get a big premium because of the VIX, it creates that buying on the dip discipline for a company that you want to own. So I do think NVIDIA is a long-term winner. Meta, Google, and the teens of multiples, they're going to see probably very stiff fines or regulations in Europe as a response to what the US is doing, but that's not going to destroy their business model. So tech is definitely a place I'd be picking up right now.
Okay, interesting. Favoured hedges before we let you go, Patrick. Are you leaning into gold? What do you want to be hedging with? Yen, Swissy, gold, something else?
US tips, long duration tips, real yields above 2%, that's risk-free. A conventional treasury is not risk-free because you've talked about China potentially responding with its nuclear option of selling all its US treasuries. The US has a nuclear option where it just totally destroys the purchasing power of the dollar to destroy, essentially defaulting on conventional treasuries that foreign countries own. So when trade wars get bad, they often get worse and extreme measures are put in place. Tip protects you from that, whereas a conventional treasury does not.
Excellent insights. As always, appreciate your time. Patrick Armstrong, CIO at Plurimi Wealth, with that short position on autos, but encouraging those who have some dry powder, not all of it, to put to work, particularly in tech equities at this moment, and also tips as a hedge. A line crossing the terminal right now. ASML, of course, the Dutch maker of lithography machines, these extreme ultraviolet lithography machines within the semiconductor space. They have that monopoly, of course. That company seeing its shares falling more than 7% on TradeGate. That is the pricing being flagged by the TradeGate pricing, at least for now, in terms of that 7% drop potentially for ASML. Of course, very much in the crosshairs of that geopolitical tension between the US, China and Europe. Coming up, we're going to speak with the UK's trade minister during President Trump's first term on how Britain and the world should respond to tariffs. Our conversation with Greg Hans is next. This is Bloomberg. Bank of England Deputy Governor Claire Lombardelli has warned that Donald Trump's sweeping US tariffs will depress UK growth, but says the impact on inflation is still unclear. I'm joined now by Greg Hans, who served as UK Minister of State for Trade Policy from 2023 until last year. He also served as UK Trade Policy Minister during President Trump's first term and started his career, in fact, focused on fixed income in terms of trading within London and New York as well. So has all of that background and experience. Greg, thank you for taking the time. We'll get to the UK specifically, but I want to start with how you characterise and frame this moment. Tariffs are now imposed on 60 nations. They vary from 10% all the way up to 104% from China. How do you characterize this moment?
Well, I think it's I'm afraid it's sadly predictable. The world has actually seen this before in 1930 with the Smoot-Hawley Tariffs Act. It's almost a repeat. Then in 1930, the US started with Canada and moved on to try and whack everybody. And it's a sad repeat with the same consequences. The markets have reacted first of all, but I think it will have a real impact on the world economy, which I think is going to be negative across the board. And I think will have a negative impact politically for the Republicans in the US, as it did in 1930, 1932. The Republicans were out of power from the White House, from the House and the Senate for a generation as a result. So, look, it's too early to tell that, but I think the impact, I'm afraid to say, has been sort of sadly predictable.
And Greg, look, as we said, you've interacted with Trump in his first term. You've interacted with members of his team, at least his former team. Do you see an off-ramp at this point for the US president?
Well, I think it's quite difficult. I think he would, to be frank, speaking politically as a former politician, I mean, he's obviously staked a huge amount on this. And it would be difficult to do a retreat, to be frank. I think he should do a retreat. And should never have gone down this course in the first place. But I think it would be difficult for him. He's basically his fingerprints are all over this. As much as Senator Smoot was in 1930. It's his name is on the policy pretty much.
UK Prime Minister Keir Starmer, we have 10% tariffs imposed on the UK, and the Prime Minister is taking a more measured approach to, for example, the Canadians, arguably the EU as well, certainly compared to China. We're suggesting that we might be able to get a trade deal, but we're not ruling out, the UK government's not ruling out retaliatory measures. Is that the right approach from the UK government?
I think it is broadly the right approach. I probably would have done three things differently. First, I think I would have been one of the first world leaders to be in Washington, not one of the last. Secondly, I think I would not be doing dynamic alignment with the EU and EU rules, which I think the UK government is going down that road. I think that would exacerbate tensions with the US. And the third thing I'd do is I'd show a bit more global leadership. The UK, along with the US, is the co-author, if you like, of the world's global trading system. The US has now sort of disappeared from that, but I think that's more reason for the UK to step up and show leadership at organizations like the World Trade Organization, potentially convene a ministerial meeting of the CPTPP free trade area. These are the sort of things I would be doing. I'd be taking a much more active approach, yes, to doing a deal with Trump, but also step up there and make the moral case for free trade, global free trade, which I think the government is not really doing at the moment. But broadly speaking, I think their approach of not doing the retaliatory tariffs, sitting down, trying to get a deal with the United States, I think is the right approach.
Yeah. What could the contours of a US-UK trade deal look like? The polls suggest that British public does not want to see chlorinated US chicken shipped into the UK market. We don't want to see a privatisation of the NHS. The digital tax is quite helpful for the revenues of the Treasury. What could a trade deal in reality look like that would be palatable on both sides?
Well, I think, when I did 6 rounds of negotiation with the Trump's then US Trade Representative, Robert Lighthizer, back in 2020, I oversaw the negotiation. And I didn't think the US at that time, I doubt would do now, is really going to be demanding that the UK take chlorinated chicken, hormone beef and all that kind of stuff. I think the bigger obstacles are probably in the tech space, things like platform liability, other things that we know that the big tech, if you like, is quite powerful in the White House at the moment. I think those would be more likely to be the obstacles. I don't think the US was really that serious about access to, NHS services. But I think a deal could still be done. US agriculture, I think you have to have agriculture in the deal. US agriculture is much bigger than beef and chicken. The US, as we know, produces a huge amount of agricultural produce. So I think there's a lot that you can do. The UK perspective, I think you've got to make sure you don't just avoid the tariffs. You get some real long-term gains for UK industry and particularly UK services, like business visas, mutual recognition of professional qualifications, the ability of lawyers practicing English law to fly in, fly out, these kind of things that will make a real boost to the UK economy. Those are the sort of things I would be demanding from the UK side, not just to avoid the tariffs.
Yeah. And the Prime Minister has tried to position himself and the UK government as able to build a closer relationship with both the EU and the US. Is it possible to strike that balance, do you think, Greg?
I think it is perfectly possible. I think that's what the UK has traditionally done. I think that's what the approach that I pursued as UK Trade Minister was. It's not an either or. It can be a both. And we can have, as we currently have, tariff-free, quota-free trade with the EU. I think we still have a very, very good trade relationship with our largest bilateral trade partner, the United States. It's not incompatible at all to do both at the same time. In fact, that's exactly what the UK should do.
The Canadian Prime Minister, Mark Carney, has said that the US is now an unreliable partner. Is he wrong?
Well, I think I would perhaps say that the current president might be. But, you've got to remember that the US will endure beyond the current president. I think typically presidents lose control of the House of Representatives within 2 years of taking office. So, and the House of Representatives, I think, would, if it was under the Democrats, I think would find ways of thwarting this agenda. So it may only actually be 2 years of dealing with the US in this mode. So I think you've got to take a longer term view, deal, of course, with the short term. That's why I think that deal between the UK and the US must take a long-term view. We've got to get some long-term things for UK industry, services industry, and some of our goods as well. But I think he's certainly an unpredictable partner. Let's put it this way, President Trump. I'm not sure if unreliable is the right term, but he's certainly unpredictable.
OK, unpredictable rather than unreliable necessarily. Former UK Trade Minister Greg Hands, really appreciate your time this morning. Another historic day, of course, with these tariffs being imposed, the implications for the UK and how the British government can look to navigate that challenge. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Today is the day then those tariffs have been imposed, and front and centre the 104% tariffs, of course, on Chinese imports into the US market. They are now in effect. As you look at the market reaction then, and particularly the divergence that we're seeing, yes, there has been pressure, of course, on Chinese equities. Today, support from the national team, expectations that maybe you get additional fiscal stimulus, and that's why, arguably, you've seen less pain on Chinese equities versus their US counterparts. So far in this trade war, Chinese equities and Chinese bonds have outperformed their US counterparts. We'll see if that continues, of course. Let's flip the board and have a look at what's happening in terms of credit. We had that poorly received auction yesterday on the Treasury front, the 10-year today, the 30-year on Thursday, because the linkages between the Treasuries and the credit markets, spreads have started to widen, but they are not at levels you've seen in previous recessions. And according to our team at NLive, you could see at least a doubling in terms of the spreads within credit on a US recession that, of course, former Treasury Secretary Larry Summers says is now expected. Let's flip the board and have a look at what's happening in terms of the Treasury markets broadly, because the rout in the Treasuries, particularly at the long end, the 10s and the 30s, continues today. To what extent is this a basis trade, unleveraging that we're starting to see? To what extent is this a question mark over whether or not Treasuries are still that safe haven, the fire sale of Treasuries, as Bank of America have called it? We continue, of course, to focus in on that, on the tariff reaction, particularly on the 10s and 30s, and that spread, the divergence between the 2s at the front end and the 10s is pronounced. The opening trade is up next. Stay with us. This is Bloomberg.